The Footprint course, Unit 9, Auction Imbalances. This is challenge day 15 of 30. In the following slide, we are going to focus on the highly effective trading habits of successful traders. Now, the focus is in creating and developing your own habits that can give you marginal edges. So you're going to see a couple of examples of some of the effective habits traders at Axia have, but ultimately you want to adopt some of these and develop your own.
The first one, obsessive morning routine. Right? The most successful traders, not just at Axia, but across the city of London, they have this obsessive morning routine. Okay? By obsessive, I mean they are there, pinpoint the exact same time, Monday to Friday. It's obsessive. It's crazy. We're talking about, some of the biggest traders, not just in the city, but in the world, that have been doing this job for 10, 15 years, still come in at 6:30 a.m. Now there's a reason to that, okay? That has become so imperative to their success that they could almost not be successful by being in at any point after 6:30 a.m. So that is a real habit. It's a habit. Being in at 6:30 a.m. is a habit. The next one, trade the opportunity, not the clock. Okay, successful traders, there is no clock. Now, my partner gets very frustrated with me a lot of the time because she always says, what time are you going to get home? When are you going to be back? And I say, well, who knows? Okay, there is no clock when it comes to trading. There's only opportunities. If the markets are moving around, if there's a Bank of Japan, if there's, something going on in Australia and we're trading the European markets, there is no clock. We don't care what the clock says. We're there for the opportunity. Form the habit early in your career. When the markets exhibit opportunity, don't look at the clock. Okay, don't work to a clock. Work to the opportunity. That is something that, again, very early in my career, I noticed, about day traders, but also even this point, the most successful traders don't look at the clock. They look at the opportunities. Healthy diet, healthy lifestyle, healthy mind. Okay, it's no secret. You come onto our trading floor and you look what the guy's eating for breakfast, you look what they're eating for lunch. Okay, I can guarantee you it's not high sugar diets, right? It's not processed diets. Most of the time, even the guy behind me, it's incredible the things he eats. We're talking salmon and spinach for breakfast, and then we're talking, all sorts of crazy, nutritious, healthy food that he's taking on. Why? Because at the end of the day, if you've got to sit there for 10, 12 hours and focus and perform at the peak, you have to have a healthy diet. Right? Healthy lifestyle. Traders don't go out drinking during the week. Okay, these Twitter pictures that people sitting on a beach drinking a beer, trading off a laptop, that is absolute bullshit, guys. I really hope you know it's absolute rubbish. Okay, a healthy lifestyle is being at the desk, being healthy, making sure you got a maximum amount of sleep, that you're mentally always focused, mentally always strong. Okay, regular exercise. On any given day, most of our traders will be forming some form of exercise, whether that's cycling to and from work, whether that's doing yoga on Wednesdays that we do regularly at Axia as a team, whether that's, doing half Ironman training, whether that's doing jiu-jitsu, whether that's doing kickboxing, whether that's doing, we've got all sorts of guys doing all sorts of exercise. And a lot of the time, guess what? They're doing it together. Why? Because they're pushing each other, because they know that regular exercise is a habit they have to have. Otherwise, their performance sinks. Then, top of the hour trading. Again, something I learned very early in my career. Any trader you ask them that has made some degree of success as a day trader in the industry will tell you they're always at their desk at the top of the hour as best as possible. Okay? And it's because a lot of the time, news releases and commentary from central bankers always tends to come at the top of the hour. Okay, there was back in 2011, 2012, there was a period of, Bank of China particularly releasing interest rate hikes at the top of the hour. So guess what? Traders developed the habit of always as, best possible. If they wanted to go out for lunch, it wasn't at 1 minute to 12, it was 1 minute past 12. They developed this habit. Why? Because in the long run, this habit made them money. Then, winning trade routines and losing trade routines. Okay, a fantastic habit that, one of the guys that sits opposite me, every time he takes a loss, I can hear the frustration, I can sense the frustration, I know the position he's in. But every time he takes that loser, he gets up, pushes his chair in, and walks away. Takes 3-4 minutes away, comes back, starts again. It's a fantastic trade routine that he's developed for himself that works for him. Equally, a winning trade routine. Okay, some of the most successful traders, when they execute to perfection, they reward themselves. They stand up, they walk away. Okay, they tick. They give themselves that mental tick of, you've done the job well. Take 2-3 minutes, and then we reset and we start again. Risk warm-up. Again, I bet most of you have never thought about the concept of risk warm-up. Okay, as traders, we have to warm up. Right? It's just like professional athletes. We have to stretch. Why? Because first thing in the morning, your conceptualization of risk is very different to later in the day. Why? Because over the period of the day, you're taking on a lot of trades, right? Which means that you are warmed up to the concept of what risk means, and you're far more or far less risk averse first thing in the morning than you are later in the day. Okay, it takes you time to get into the flow, into the momentum, into understanding where the risk is. So most professional traders have a habit, first thing in the morning, they reduce their clip. They risk less early in the day until they warm, and then they move their risk up. Structured exact morning briefing and afternoon debrief. You come into our office any morning and you ask a trader, can I see your morning sheet? And guess what? They're filling in the exact same morning trade sheet that they've done probably for a couple of years. And again, there's no secret as to why they do it. That structured morning briefing allows them to be in a very specific mindset before the markets open. Okay, it's a technique called priming. You've got to prime your mind to be in the right mental state before the market opens. Okay, so every morning you prime your brain to be ready come the open of the markets. It's the same thing in the afternoon. Our most successful trader, okay, and it's so wonderful. It's something that I'm very weak at, and I've been so fortunate to see for so long now. His afternoon debriefs are incredible. I mean, he's got this set of Evernotes that dates back for almost 6 years. And if you see the concise manner in which it's completed, it is incredible. You will sit there in awe going, wow, I can see why this guy is successful, because he pays so much attention to detail when completing his trading at the end of the day. Number 9, fundamentally sensitive markets. Now, this ties in a little bit with, trading the opportunity, not the clock. 2 of our very successful traders, when the markets have become more fundamentally sensitive, in other words, they're a little bit more sensitive to little comments, okay, not necessarily fundamentally moving news, but little comments, they will sit there for as long as humanly possible. If that means staying there till 11 o'clock at night and then coming in 6 o'clock in the morning, they adjust themselves to the sensitivity of the markets. They don't move, they don't go out to eat, they don't go to the bathroom, they just sit there and trade the fundamentally sensitive markets. Then, the last one. Every single successful trader I've ever seen, and I've been so lucky to see a lot of them, they keep the execution simple. They don't try and pyramid. They're not looking to average. They're not looking to, do all sorts of crazy and wonderful, exotic kind of ideas. They do the most simplistic, trade strategies. And that is what makes not just, every single guy I've worked with, but probably every single trader across the world. Right? These are 10 highly effective habits that if you can implement them into your trading, you will start to see results 1000% guaranteed. Okay, why? Because they are tried and tested. They've been utilized across every single trader I've ever seen. Now, it's not to say that if you have all 10 of these, you will suddenly start making money. Okay, let's pull the wool from your eyes. It doesn't work like that. But what it is going to say is, bang, if you come in every morning and you've got the exact same trade sheet to complete and you complete your debrief every single day, you're going to see consistency. And that's the key to building a habit. It's consistent. It's not Monday, Tuesday, Wednesday, and then skip Thursday, Friday. It's Monday, Tuesday, Wednesday, Thursday, Friday. Saturday, Sunday, you take a break. And Monday, Tuesday, Wednesday, Thursday, Friday, you come in again. And you build that consistency through proper habit development. That's the key, guys.
So this is then obviously the second of our momentum-based strategies. Note, obviously, it is a standalone strategy. You're going to see a lot of examples of the auction imbalance. I'm going to show you how to use it as a standalone strategy, but also how it can be utilized as a profit take, a stop, and all sorts of other identifiers. So it's a really, really crucial, principle, the auction imbalance. But I'm going to show you how to use it very effectively. This is obviously one of my more favored parts of the footprint tool. It's something that really, really does, make the footprint tool extremely valuable. Now note, obviously, in terms of the execution style, we will be adopting predominantly a passive execution style. So as with every unit of the strategy sessions, we do focus on all the principles and which ones will be utilized in the strategy session. As you can see, again, multiple principles will be utilized in the strategy session, but some of the key highlights, one of the most important ones is volume. Obviously high volume areas and low volume areas, as well as delta pocket positioning and also liquidity. Do note, obviously, we identify our imbalances with nice bright green lines. This is so we don't miss out on them and ultimately miss out on what they mean. All right, we're going to now move on. We're going to get onto the blackboard and we're going to begin the process of developing auction imbalances. So the imbalance auctions are hands down my favorite of all the principles and strategies with the footprint. It's probably also the most commonly known. If you go and type in maybe YouTube, you might just find one or two videos about auction imbalances. But for me, the reason I really, really like auction imbalances is not just the strategy focus, but more the principle of auction imbalances. In other words, what it means. Okay. Now, what I mean by this is that sometimes as traders we get so focused on a strategy and a market doing something that we almost ignore all the other information coming towards us, and that's where the strategy can be so wonderful, because auction imbalances are giving us very vital information from the market. Now, like I said to you in the last strategy session, trading is not just about having your subjective ideas and executing them. All right, it's about having the fact-based observations from the market and executing upon those. Now, auction imbalances will not only provide a strategy-based opportunity, but it'll also allow you sometimes to maybe take profits on another strategy, or it might allow you to put a stop in place on another strategy you might have. So you're going to use auction imbalances not just with a strategy, but you're going to use them in initiative drives. You're going to use them in breakout trading. You're going to use this principle throughout, and that's why, hands down, this is probably one of the most important and my favorite of the trade strategies. Now, before I go any further, I'm actually going to spend a bit of time explaining exactly what an imbalance is. Okay, I need to get this principle across very well. It might not have come across that well within Unit 3, so I'm going to draw it out for you. And I'm going to start off by going, and I'm going to illustrate the market came down, and then it started to reverse. Now, we're going to pay close attention to this little area, and I'm going to draw 5 prices. Okay, and we're going to call these prices 60, 61, 62, 63, and 64. And we're going to call this 6 times 50. Okay, let's say this is, for example, the oil market. Okay, and we're going to call this 200 by 90. And we're going to call this 250 by 100. And we're going to call this 400 by 100, and then we're going to call this 600 by 400. Okay, so what you can see there is just a basic footprint tool. Now, what I want you to observe, okay, is what exactly an imbalance is. Okay, now imbalances we always observe diagonally. Okay, so when prices are going up, we observe them in that direction. When prices are going down, we observe them in that direction. Now, an imbalance is nothing other than a really big degree of variance in the volume traded between two prices. Okay, so if we highlight maybe these two prices, we can see 6 by 200. Okay, so that discrepancy of 194 lots is what we call an imbalance. Now remember, the footprint is nothing other than a tool to show us the interaction between buyers and sellers. So when the interaction shifts, when the nature of how buyers and sellers are interacting shifts and changes, that provides clues, but also opportunities. Okay, and ultimately, that's what the markets are about. The markets, in theory, spend most of their time in sideways motion, and then every now and again they trend and auction. So it's about knowing when these imbalances are in play, so that we can ultimately go with the flow of the market. Equally, if you're someone that likes to go counter the market, you always need to be aware of these imbalances, because again, you never want to go against a market when there is an imbalance. Why? Because the very nature of an imbalance is that there is a lot more strength, from one side, whether it's the buyer or the seller. Okay, so the imbalances, I'm going to draw them out for you. We can see this imbalance is 194. We can see this imbalance is 160. This imbalance is 300. And this imbalance is 500. So the imbalance is nothing more than the difference between the contracts traded on the best offer versus the best bid. Now, if you want a further explanation of why this is important, you need to think a little bit about a price ladder. Okay, so the market's come down and it's come to this price point 60. Now, off of this price point 60, we've suddenly seen a really big imbalance in the market. The nature of the price action has shifted very, very aggressively. Okay, and this is how it shifted. In other words, buyers have bought 194 more contracts at the best offer versus sellers. In this instance, buyers have bought 160 contracts more than the sellers at the best offer. Buyers have bought 300 more at the best offer versus 100 at the best bid, and buyers have bought 500 contracts more than the sellers at the best offer. Okay, so in other words, it's showing us that buyers have become very intentional to lift higher prices. Okay, now what it also means is that ultimately there are sellers offering up those in prices, and this is key to understand. Not just is the imbalance important, i.e. very strong buying, but equally, if this becomes very dark and very red and there's a lot of absorption, that's telling us that not only are the buyers becoming aggressive, but equally there's potentially some sellers caught in the market. And that's one of the key principles we're going to focus on, which is high versus low imbalances. So low volume imbalances. Okay, as a general rule of thumb, make a note of this. Low volume imbalances will tend to reverse, okay, i.e. fill out the imbalance. High volume imbalances will tend to continue initially and later come and fill out. Okay, so that's the key thing. An imbalance is actually an anomaly. It's an anomaly within the auction process. For buyers to suddenly become this intentional and this aggressive, we always have to ask ourselves, why? Why have they become suddenly this aggressive? Okay, now let's move on to some of the variations, or in fact, let's move on to some of the key observations, before we actually get stuck into the principles of the strategy. Now, what I want to point out is, again, like I said to you in Unit 4, sorry, where I showed you how to set up an imbalance chart. The most important thing is that minimum difference. Okay, so if you go onto your settings, you can obviously set a minimum difference. For me, I tend to keep it at 0, and I'll explain to you now why. Okay, some people prefer to have some sort of a minimum difference. Otherwise, very simply put, if you had, let's just say, an example like 0 and 10, and you had your imbalance set to whatever, 2, 3, 4, 500%, it's going to always show an imbalance there. Okay, so for me, sometimes it's good to maybe have some sort of a minimum difference. Maybe if you had 10 contracts as the minimum difference, therefore, if you had something like 0 and 40, obviously it'll discount the first 10, which means the imbalance is only 30. And if you had this obviously set to whatever percentage, it'll still show up as an imbalance. Okay, but having that minimum difference might just get rid of a bit of the noise. Now, the reason I don't like to have a minimum difference is because I want to see when there are low volume imbalances and when there are high volume imbalances. Okay, so That's the first thing. Again, those differences solely market dependent, guys. I don't want to say 10 for oil, 20 for SPOOs, because again, then you're going to move away from learning principles. You're going to try and adopt the exact same, sort of process that I have, and it's not going to benefit you in the long run. I think one of the things we spent a lot of time with, earlier on in this unit was the concept of habit building, and ultimately, if I was to be very crucially honest with you guys, anyone can become a trader. Anyone can be successful at trading, right? There's this fallacy that traders have something unique, something special. They don't. Traders are just very habitual by nature, and by habit, we don't just always mean get up at 5 o'clock, eat breakfast at 7:30. Yes, okay, those are habits, but also habits in their processes. Okay, so they adopt the same processes every day, which is why ultimately, after every single strategy session, what am I getting you to do? I'm getting you to complete the template. Okay, I'm getting you to learn a very, very habitual process of templating. Okay, if you do this over time, you're going to develop a very strong habit and ultimately some very good consistency. Now, before I move on, I mentioned something about a principle-based approach, okay? What a lot of courses do, and this is important to highlight, what a lot of courses do is they want to give a man a fish. I'm going to write it like that. They want to give a man a fish. Okay, now, why I find this horribly wrong is that when we give a man a fish, ultimately, he'll be satisfied for a couple of hours, couple of days, but eventually he's stuck with the same problem, okay? And it's the same thing with regards to trading. If I give you the exact process and I tell you, okay, keep your difference to this, keep your minimum percentage to this, when it gets to this exact price, you put it here, you put the exact stop there. If I give you that process, well, guess what? The markets are going to change. 100% they're going to change. They're constantly changing. Okay, if you're not aware that markets constantly shift and adjust, then you're not observing them enough. So the whole point is that I don't want to give you a fish. I want to give you a fishing rod. Okay, I want to show you ultimately what every strategy's underlying principles are. Okay, because guess what? It's not the support or the resistance line that ultimately makes a market go up or down. It's the underlying principles around that support and resistance that make the market go up and down. Example, initiative makes the market go up aggressively. Responsive shows us a high amount of liquidity being utilized. Balanced markets tend to struggle to break out. Imbalanced markets show us good breakout opportunities. Now, knowing these basic principles, ultimately, not only can you adopt the strategies I'm showing you, but you can ultimately then learn to catch your own fish. And that's the purpose of this course. The purpose is for me to teach you the principles, give you a habitual process to learning and adopting those principles every single day, in hope that not only do you adopt my strategies, but learn your own. Okay, let's get into that now. Let's talk about those principles that you're going to find within the auction imbalance. Okay, so strong and weak auction process. Now, again, I think best way to start is to just draw a little bit of an imbalance again. So let's go 10 and 100. I'm just going to draw the top ones here, guys. 20. I'm going to make it really almost silly. 30 and 100 and 40. Okay, so we can see obviously the imbalances. Oh, let's go back. So you guys can see the imbalances there. I don't want to spend too much time drawing out imbalances. Okay, so alright, so there are imbalances. Now, ultimately, the first thing to interpret is a strong and weak auction process. So, in theory, okay, an auction imbalance is, in theory, is a strong auction process. Okay, however, and this is the most important thing to understanding the strategy, it's only a strong auction process if the imbalance is lifting dark colors. Okay, this is the real key. So if you have some real dark colors as the imbalance is created, you're getting some real dark shades and dark shades and dark shades as we go up, right? In other words, real offers are being lifted. The buyer is being that aggressive and he's lifting very high amounts of volume. That sort of imbalance shows us a strong auction process. Now the counter or the flip of that is a weak auction process, i.e. where we have an imbalance, but for instance, maybe it's only 20 by 70. Okay, in other words, it's low amounts of volume, or 1 by 6, or again 20 by 140. Okay, this is a far more weaker auction process than, say, for example, we had much higher numbers. You have 200, 200, 300. Okay, I will show you examples in a bit, but just understand that basic premise. A strong auction, we're lifting high amounts of volume as we going in the diagonal way, of course. And a weak auction, again diagonally, but we're lifting very small amounts on the offer. Now, the basic premise, the rule of thumb, a strong auction won't always reverse straight away. Okay, it's likely to continue. A weak auction will likely reverse. Now, where I learned this, actually, this strategy, was if you've been a German Bund trader for a long time, you'll notice that a lot of flipping comes into the market around about lunchtime, midday. Now, this flipping very often will look like a weak auction imbalance. So, if you want to learn to trade this, one of the best times to trade this in, say, for instance, the German Bunds is around the lunchtime. So, 11 o'clock to 1 o'clock in the European session. Okay, now, I'll go through the variances or the variations of the strategy in a minute, but let's just talk about some of the other principles. Now, imbalanced versus imbalanced markets, okay? So, imbalanced market, again, like I always say, a market that's out of balance, okay, so i.e. we're trading relatively close to the previous day's extreme or even outside of the extreme on either side, okay, for me, you tend to see much stronger auction imbalances at those extreme points. I'd be far more cautious to fade those. But again, don't worry, I'm going to show you an exact strategy of how to fade, when to fade, why to fade. So, in an imbalanced market, we are likely to see more of these imbalances, whereas in a balanced market, where we're trading smack bang in the middle of the previous day's range, we are likely to see more weaker type imbalances, which, like I said, tend to reverse upon themselves. Now, note, I've mentioned the high and low volume. That is a key pivot, as you will see. Also the delta. Okay, so the two key metrics we're going to pay attention to are the volume and the delta, and obviously the shading. Okay, I think the shading is really, really important because that's going to show us the relative shift. And those are the three key metrics we're going to pay attention to when we get to the examples. Okay, we expect to see dark shading for strong auction imbalances, high volume for strong auction imbalances, and high relative delta. Why? Because we're lifting very big offers. And obviously the flip for weak auctions, we won't tend to see much dark shading. Volume will be relatively normal and muted, and the delta will hardly shift. Okay, now in terms of why this imbalance occurs, this is quite important. Okay, so sometimes an imbalance can occur because of stops. Okay, so maybe the market reaches a certain point and suddenly we get a stop out. Okay, now stop out imbalances do tend to fill out. Why? Because naturally when a market stops out, obviously it's stopping out simply because one order is trying to get out of the market. Okay, so those imbalances do tend to fill out. Another reason for imbalances is when we get some key fundamentals in the market. Again, these don't have to fill out. Why? Because those fundamentals can be particularly important. And the third reason we get imbalances is because of initiative in the market. And we will talk quite extensively about this strategy a little later on. But that's one of the third reasons why we tend to get this imbalance. Okay, obviously, as I mentioned with stops, sometimes we assume stops only occur at an extreme. They don't. Okay, stops can occur in the middle of a range if there's some positioning, like I showed you in one of the strategies earlier with the failed support and resistance. You can have an auction imbalance in the middle of the range. Equally, when we get onto the point of a delta unwind, you'll see again some stop outs in the middle of the range occurring. Okay, now those are predominantly the most important principles of ultimately the imbalance process. Now, let me show you what the variations are going to look like, and then we can start to develop a strategy approach. Now, so important, guys. Context matters a lot in terms of the trade strategy. Okay, it's so important that whenever you look at an imbalance and you identify it, that you put it into the context of where is it trading right now, why has it occurred, is it stops, is it just a fundamental piece of news, or is it just low volume? Okay, so make sure you always interpret the context behind why that imbalance is occurring in the first place. Now, the first thing to observe, like I said, is you can have a minimum difference. Okay, as explained, that's up to you. The second thing is the percentage. Okay, now this is the percentage to create an imbalance. In other words, between 100 contracts and 400 contracts, that will create an imbalance if I set it to 400% or bigger. Okay, now again, this varies tremendously. Okay, there is no right or wrong in this, but what I would say is don't go less than 200% for imbalances, and don't go more than 400%. Okay, the reason is if you go more than 400%, you could be missing out on a lot of information. If you go less than 200%, you could be including too much information. So the whole point of that setting is to, again, extract meaningful information, to only take out the information you ultimately want to know. Okay, so again, a lot of people always ask, should you have a separate chart? Okay, this depends. It is easier to see on a separate chart, of course, because it only shows color where an imbalance occurs. So if you're going to adopt the auction imbalance as maybe one of two strategies from this entire course, then yes, have a separate chart. Okay. Equally, if you just want to focus on imbalances, then have multiple separate charts of just an imbalance chart. If you're going to trade multiple strategies, you don't have the space, then by all means, you can have the same charts. You can have a rotation or a time-based, and as you'll see in the examples in the next couple of slides, I will show you that you can learn to identify imbalances simply by light and dark colors. Okay, so you're going to learn, your eyes are going to learn to adapt to what an imbalance looks like on the chart. Now, note, one of the most important things, and again, there is no exact answer here, but how many prices do you need for an imbalance? How many in a row? Okay, it all depends. Okay, I don't want you, this is why I teach you principles and I don't teach you exact science. Okay, it all depends. What I would say is that ideally, you want more than 3 prices. Okay, so you want 3 prices showing imbalance. Ideally, you want those 3 prices to be within a 4 price range. Okay, so what I'm saying is you could have an imbalance there, there, and there, and that's enough of an imbalance. 2 prices, okay, a little bit too shallow, probably not aggressive enough. 4 or 5 prices maybe being overly aggressive. Again, what I would say, the more important thing than the prices to focus on is what is physically being lifted here. Okay, what is the physical volume being traded? Is it high presentation of volume, or is it low? That's the real key to understanding imbalances. Okay, now, like I said, this is a great strategy to know because it's going to assist you with stops, targets, all sorts of other kinds of strategies that you're going to learn. So just do bear that in mind. And then note, obviously, one mistake people make, stops. Okay, stops are a form of imbalance. Okay, so we're going to say stops are equal to imbalances. Okay, it's a type of imbalance. But an imbalance, okay, doesn't equal a stop. Okay, so in other words, you can have an imbalance that's not created by a stop. Okay, but stops are all imbalances. Just something to be aware of. Now, let's go over the variations as well as the execution that you're going to need to adopt for this trade strategy. So, the first variation is we get the initiative. Okay, the initiative comes in the form of our nice imbalance. Okay, and that's how I'm going to represent imbalances. So we get the imbalance, the market extends, it runs into liquidity, and once it finds the liquidity, it backs off. Now, the market is always going to try and test that imbalance. Now, what you want to do is you simply want to wait for the absorption. Note, this is the key. You want to see absorption in front of that imbalance before you execute. This is a mistake most people make. They simply just put a bid there. Now, the problem with that is that, again, if you recognize it as high or low volume, that's a good enough objective fact. However, you want to see the absorption first. Why? Because it's the absorption that tells us that initiative created in this imbalance still exists. In other words, the buyers were aggressive from this point to this point, and they're equally aggressive because they're still absorbing at higher prices. Okay? And we're just simply looking for a little bit of a rotational retest of the extremes. Now, in terms of targets, I'm not going to spend a great deal on this because the target depends on the context. If this is an imbalanced market on a breakout, we could be looking for continuation extension. If this is an imbalance in the middle of a balanced day, well then you could be looking to take profit for a couple of ticks. Okay? In terms of risks, it's very simple. We don't want to see that imbalance begin to fill out. Now, like I said to you in the previous strategy session, when imbalances do begin the process of filling out, be very cautious because they're likely to then spend quite a bit of time filling it out. And that's our second variation. So once the market then gets back below that absorption point, okay, we want to look for a short-term scalp looking to target the bottom end of our imbalance zone. Okay, so what we're looking to do is we're looking to simply play within this sideways zone. Now again, this is where it's crucial. This strategy is going to work far better, i.e. number 2 and 3 is going to work far better in balanced markets versus, oh, that's supposed to say imbalanced. Okay, far better in balanced markets than in balanced markets. Okay, so if we're in a balanced market, we look to sell through that absorption low, target the low of the imbalance, and then cut and reverse on the low of the imbalance and trade it back up. Why? Because we know the process of an imbalanced market is to fill out the imbalance on both sides. Okay, so we're just simply using a principle, and we're adopting a strategy according to the principle. Let's go through it again. Step 1, we always trade in the direction of the imbalance. We wait for the absorption, and then we enter aggressively by buying the market. Target depends on the context. Once we take out that absorption zone, we look to be an aggressive seller, targeting the low end of the imbalance, where we cut and reverse and buy the market. Okay, now what we're going to do is we're going to go through a couple of examples, and then hopefully you'll get an idea of some of the what it looks like a little bit better on the footprint chart. So first example is the E-mini S&P 500. This is the 20th of December, and we can see this is in the afternoon session, and we can see our first little imbalance steps in here. So we're going to do a nice little square there. Imbalance comes in. Now remember what I said, it's all about the relative volume, okay, and the delta. So note the pickup in the delta on this rotation, very high. Okay, so we've got a very high imbalance. We even have zero print. So we have one imbalance, two imbalances. Okay, now when you get two imbalances, obviously it speaks for itself. It's even more aggressive. Okay, so we've got the high volume and we've got the high delta, and more importantly the high cumulative delta. Now when we see this imbalance, okay, we need to know which context it's in, where we're trading, balanced, imbalanced market, high or low volume. Now this is a high volume imbalance, so the first thing we're looking to do is trade once we get the absorption on the retest of the imbalance. So we can see we get the absorption, 1671. It ticks one tick lower. As soon as it goes bid, we want to be looking to be a buyer. Now obviously in this example we can see that the market does extend to the high. In terms of the stop, it's very simple. We would have placed the stop there, and we would have looked to try and buy again in our second imbalance zone. Okay, obviously the market held this imbalance zone and kept holding it whilst rotating. Okay, so that's our first example of an imbalance type strategy. Now let's look at another example. So this example now is a little bit different. Again, volume may be a little bit lighter. How do we know that? Well, look at the colors, guys. Look at the relative color. Okay. So what we can see is obviously the market creates an imbalance. Okay. High volume, high delta. Okay. So a really relatively efficient, or as we said, a high volume imbalance. Therefore, we are looking for the first retest. Note we're looking for the absorption. Okay, what do we see? Absorption. Now again, as I always say to you in terms of tips, you need to know what high absorption is. Okay, 41 contracts in the gold, 29 contracts, 32 is not absorption. Okay, 114, that is absorption. Okay, once it took that absorption, note the reaction. Okay, uneven, a little extension. Alright, obviously, look what happens once we come back. Okay, note this time, we get more absorption. Let me erase that. So we get more absorption before what happens? Before we get a little push to the other side, what does it come and test? The other side of the imbalance, and we ultimately then get the fill out process beginning. Okay, so in the second example, we would have been a buyer there looking for obviously a cut and reverse somewhere around one of these two prices. We would have cut and reverse and traded it back towards the lower end of the imbalance, which is somewhere around there. Okay, and we can see that the market really gave us all three. It gave us the sell on the absorption. What was quite nice as well is, again, I always talk about clues, but note the imbalance here once that absorption occurred. Okay, so we got the absorption, bang, straight away. We get the imbalance 232, 41.85, 61.185. We got quite a strong imbalance. Okay, so another really good example of a high volume imbalance. And again, guys, you don't have to, you don't have to think a great deal. I mean, I know sometimes it's difficult to keep up with all the metrics of what's high volume, what's low volume, what's absorption, but that's what the footprint tool's for. it's got the colors. Okay, so we can see dark blue shows us high relative volume. So we know that imbalance is on high relative volume. Okay, in terms of this imbalance, if I just went through it, we can see obviously 0 and 47, 22, 48, 6 and 71, 34, 188, 83, 126. So a good 4 or 5 price imbalance. Okay, and that's our full example then of what the auction imbalance looks like. Now, let's have a look at another example. So this example again, this is now in the German Bunds, like I said, my favorite market. And I'm going to show you what a low volume imbalance looks like now. Okay, so this is where the imbalance occurs. Notice 14 to 65, 26 370, 1 and 65, 0 309, 344, 845. Okay, we will talk about this in exhaustion highs and lows. When you do get an imbalance at an extreme point, the market does tend to back off and relax a little bit. Now, note the relative volume. Okay, a really low, a low volume imbalance here. Hence, we're looking for a short side trade. Again, looking to, let me go back one step. In this example, we're not going to be looking for a first time buy. Okay, so we're not interested in the first part of it. If anything, this is one you either want to leave alone, or, like I said, you could be willing to be a buyer, look for the buy, look for a little bit of rotation, and look for the fill out process to begin between the imbalance zone. Okay, so that's an example of what a low volume imbalance will look like, as well as obviously the outcome. Now, the last example, again, this is in the oil market, and what we can see, a little bit of stop out actually taking place, and again, interesting that the same amount of contracts, 116, 116, but we can see the imbalance kind of starts over here. In fact, it actually starts a bit lower, so we can see the imbalance starting a little bit lower, and we can see that imbalance going all the way up to somewhere around here. Now, I did mention to you, obviously you can use rotational charts as well as time-based charts, and you will still see these imbalances. Again, remember they're going to be shown with most likely it could be dark colors or light colors. If they're darker colors, we know it's quite a high volume imbalance. If they are lighter colors, we know it's quite a low volume imbalance. But do recognize, I mean, you can, again, you got to pick up on the numbers. So you'd be, sort of looking over this. What I will say, if you don't have the imbalance chart, you'll normally see it with a shift in variance. So if you ever see a shift in variance or volatility in the market, a greater number of prices over which the market's trading, have a look up. There's most likely going to be some form of imbalance. Highlight that imbalance. Note step 1. Is it high volume? Yes, it is. Is it a high delta? Yes, it is. We're looking for the first pullback. Note the absorption. We look to be a buyer. We target the extreme. Note once it comes back below that point, okay, we can see, look at the absorption taking place. Okay, so quite a lot of absorption. Put forward, filters down lower, and ultimately the market begins the process of filling out. Okay, so that's the 3-step process of trading an auction imbalance. Now, let's go look at 2 practical examples. I'm going to go through these with you. The first one is the E-mini S&P. Again, I'm going to show you this on the traditional imbalance footprint chart, so you can see it quite clearly. Note, obviously, on the footprint imbalance chart, you can see the colors where the imbalances occur. So you'd be looking for 3 or 4 of those. We obviously can see a little bit of an imbalance occurring here on the left side. That is our imbalance ultimately, and so that's what's got us now interested. We got 1 imbalance, 2 imbalances, 3 imbalances within the market, maybe even 4 there. So a real strong imbalance. Note it is a high volume imbalance as well as a high delta imbalance. So we're looking for that first little pullback into the imbalance area. Now, note this example. It did the absorption. It didn't quite give us the perfect price point. It kind of absorbed quite a lot around this 574 before taking off. But if you fast forward it, we'll see what happens. Ultimately, the market continues in the same vein in the direction and keeps defending the imbalance. And what we're interested in is when suddenly the imbalance is now complete and the market chooses to go in the opposite direction. So note, the first thing, obviously, a little bit of an imbalance at the 35s, 329 trade down, straight away onto the 34.5s. What we're looking for now is a short side trade to fill out the imbalance down to the 33. So note again, there's the imbalance, another potential imbalance, no real buying through the market, another imbalance, so an imbalance in the opposite direction. confirms the short side trade. We're looking for profits in and around this 33, and we're looking to cut and reverse and fill out the imbalance. Okay, so we can see obviously the market begins the process of absorbing. As soon as we see that absorption, okay, we know that there's a buyer stepping in holding the market, and obviously once the buying or once the selling is done, the market then turns back around, goes back bid, and ultimately the market then begins to fill out the process of filling in the auction. Okay, I'm just going to show you this, how it fills out. And so important, guys, with these auction imbalances, you know, it can take some time, but the whole point of an imbalance is that it can spend a lot of time filling this area out. Markets tend to turn imbalance zones into very balanced zones, or low volume areas into very high volume areas. Okay, so I'm just going to fast forward this a little bit quicker. Do bear in mind, all of these videos are available for you in these slides, so you can go back and watch this yourself, or ultimately you can go and watch them in the drill section. Okay, slowly but surely the market starts to rotate higher. Bear in mind, we're looking for a sell now, again at the top of that imbalance, around that 11,100 lot, and let's see how the market responds. Okay, straight away bid into the area, and we can just see the process of accumulation absorption. Okay, so that's our first example, and now our second example, and the last one for this strategy session is the gold. This is obviously a time-based gold footprint chart. Do bear in mind, obviously, this is no longer an imbalanced one, but as I mentioned to you, note the volatility. Okay, so we can see average prices are about 7 prices. That's the average rotation. If suddenly that shifts to 14 or 20, we know there's a high probability for some form of an imbalance. So let's have a look now. So we can see the market is trading at these lows, and suddenly it takes off. Get aggressive initiative coming in. We've got one imbalance. We've got two imbalances. So very similar to the SPOOS example. We've got two imbalances. Note, this is no fundamental news or anything. It's just simply a very volatile market. Again, note the volatility pickup. That means there is potential for an imbalance. Now, what we're looking for is a retest ahead of the imbalance, so somewhere around that 67.4, 67.3. So let's fast forward this a little bit. So the market comes, after extending all the way up, comes all the way back. Notice where it stops. Okay, stops there. Remember what we said, we're looking for the absorption. That's our clue. We get the absorption, we're looking to be a buyer of the next price. Okay, but this time, notice what the market does. Okay, so we get the absorption, but all of a sudden the market goes through the first imbalance. Now remember what I said to you, we have to keep a tight stop. Why? Because if we fill out, or we remove, or get through that first bit of absorption, the market's likely to continue low and fill out the imbalance. Okay, so keep the stop tight. Equally, don't be afraid to cut and reverse there short, and then get long for the bounce back up. Okay, obviously we do have the second imbalance then. Again, note how the market comes down to it, a little bit of absorption beforehand, and then it bounces back up. Okay, and that's the process. If I fast forward this, you'll see the market then begins the process of filling out over a period of half an hour, and that's the end of our imbalance examples. Now, so important, guys, the imbalances aren't just a strategy focused opportunity. They are there as principles for a lot of the other trade strategies we adopt, and some of the other trade strategies you might already have. Let's go now and fill out the template in the next following slides. Now, I really hope you enjoyed that strategy session. It truly is one of the most important principles that comes from the footprint tool. Again, I introduced a lot of variations there, a lot of methodologies to execute upon, and a lot of reasons why the imbalance strategy is definitely something you want to adopt. Maybe not so much from a strategy perspective, but at least from a principle understanding perspective, as it can aid you in making other trading decisions. Now, note obviously in terms of the template. Now, I really hope you enjoyed that strategy session. It truly is one of the most important principles that comes from the footprint tool. Again, I introduced a lot of variations there, a lot of methodologies to execute upon, and a lot of reasons why the imbalance strategy is definitely something you want to adopt. Maybe not so much from a strategy perspective, but at least from a principle understanding perspective, as it can aid you in making other trading decisions. Now, note obviously in terms of the template, in terms of trending consolidation, obviously in market context, these imbalances can pretty much rock up anywhere. I think that was something that I think you've come to figure. Obviously, they tend to hold, or the imbalance variations tend to work better based on a volume ultimately being traded. So that being said, in terms of market context, in trending markets, obviously imbalances are going to be a little bit easier to trade compared to obviously consolidation. Note obviously the reason being obviously trend brings higher volume and more participants in. Now, obviously in terms of the balanced and the imbalanced, we note again imbalanced markets do tend to bring potentially higher probabilities for imbalances that don't always get filled out straight away, so rather extend upon themselves first before later filling out. And then in terms of trade location, where we could find some of these imbalances, we spoke about breakouts, stops in the market, potential delta unwinds, as well as fundamental market movers. Now, that's some of the context we can find it in. Obviously, as you go through those imbalances and you find them, you'll highlight each one of the specific parts of the market context in which you found the imbalance. Now, in terms of conditioning and market conditioning, well, it was important to understand the time frame participants, and we spoke about how if there's a high amount of volume and we see really dark shades of delta pockets and high volume areas, that signals a lot of liquidity being provided and ultimately influential larger time frame participants. We did note obviously if it's lower volume, that's more of a speculative or algo in nature and is more likely to potentially reverse. Now, in terms of that liquidity, we noticed high liquidity obviously implies a larger imbalance and continuation, whereas low liquidity obviously a much smaller chance of extension and a much higher probability of actually returning and filling out the imbalance. Don't forget, obviously, we did speak about, I know we obviously had the initial variation of the extension and the potential retest before, or the pullback and then retest, but we then did speak about filling out the balance as well, and scalping it on both sides. Again, it's not necessary that you have to take on all three variations or try all three strategies. It's there for you to observe, try, see if you're willing to adopt it, see if you're willing to take on some of those scalps. Like I said in the previous unit, when we spoke about the elephant or hiding behind the elephant, traders don't necessarily take on these little scalps because we want to hold it for big winners. We simply do it because we can nick ticks with a very high degree of certainty. Okay. In terms of volatility then, it will be seemingly high. Now, this is where you've got to be cautious, as we mentioned. Sometimes it can seem volatile simply because price moves quite aggressively, but it doesn't necessarily mean it is an aggressive directional move. And that's where we focused heavily on not just the volume, but also the delta coloring. Okay, let's now move on to the strategy identification. So then in terms of obviously identifying the patterns, don't forget obviously we use nice bright green lines. We did highlight obviously how to have an imbalanced chart and how you could easily see them with an imbalanced chart or your usual charts, but you would require being more observant of the price or of the lots traded at each price. So firstly, in terms of obviously interaction, note we spoke about the initiative being taken, hence the imbalance. Now note, it's initiative only in high volume. Okay, high volume is initiative, whereas low volume, it could be considered initiative, but it's very low volume initiative, which is sometimes reflective of maybe a little bit of stop up, maybe a little bit of a speculative type move, which more often than not going to reverse. In terms of obviously interaction, it's quite aggressive in nature, looks very aggressive on the ladder as well as on the footprint. In terms of the metrics, we spoke about how important volume is. It cannot be stressed enough. High means continuation, low means reversal. Okay, in terms of time, I did mention the idea or the concept of time being quite crucial with this, okay? Obviously, earlier on in the session, it's more likely there's going to be higher volume, higher liquidity, therefore, more likely to see, sort of imbalances coming in, which potentially can hold and continue up or continue with the imbalance. Whereas later on in the day, towards lunchtime or quieter periods where the volumes are much lower, we do tend to have a lot more imbalances that can be reversed. Now, in terms of the delta, obviously we do have high volume and low volume deltas, and I showed you how to see that with the delta shading. And obviously then in cumulative delta, not really relevant in terms of the strategy. It is a little bit of a shorter term time frame strategy, but you do expect it to go when there's high volume, initiative being taken, and we see these imbalances. You do expect the cumulative delta to go with the trend or in the direction of the trend. And then obviously note, in terms of relative changes, we will see a shift in the volume price delta, particularly as the high volume, imbalances come in. But note, obviously, when we have low volume imbalances, you might not see these relative shifts. So again, you can lean on those relative shifts to identify, is it a low volume, auction imbalance, or is it a high volume auction imbalance? Okay, let's move on then to the execution part of the template. In terms of obviously then the execution side, starting with the money management, note obviously we've got, depending on the variation you're taking, you can afford to be a little more passive in terms of entry. Why? Because once we get that a bit of initiative and the imbalance created, we do want to wait for the market to come back. Okay, so we will get a fill passively, and note once we see that absorption ahead of the imbalance, that's where we're executing. Our risk obviously simply goes below that. Somewhere within the imbalance note. If the imbalance does begin the process of filling out, it's likely to trade both sides of the imbalance, hence why we stop out within the imbalance. Note obviously in terms of target, when there's higher volume, we obviously have higher potential targets, because we could see obviously at least a retest of the extreme or even an extension of that extreme. So again, this is where context will be quite crucial, and again also another really good example why I don't like to give targets. I really despise this idea of where should I get out, where should I take profit. Okay, this is something you will learn through time. You'll learn where best is to take profits and where best is to place your stops. Okay, obviously note obviously if you are going for the reversal variation, do keep your stops very tight and your targets very tight, because you've got relatively small targets in play. Okay, in terms of obviously then risk reward, for the first variation, for good reason, it is very high risk reward. For the second and the third variation, much smaller winners with equally small stops. So again, if variation 2 and 3 are not for you, that's okay. Okay, only adopt variation number 1. In terms of the application, it's an exact execution. We don't want to time this. We don't want to preempt it. We don't want to second guess ourselves. We simply wait for that absorption ahead of the auction imbalance, and we enter. We're not going to leverage on this one. No interest in leveraging here, simply because it's just going to skew our risk reward ultimately. So no need to leverage. And our tip: be switched on to identify early, whilst others get caught up in the price action. This is something that's crucial, right? When there's a bit of volatility on price ladders, professional traders have a very bad habit of getting sucked into the ladder, getting sucked into what we call the Vegas lights. And the Vegas lights are simply that when the price is moving around quite a lot, you assume there's opportunity. Okay, that isn't the case. Volatility does not necessarily mean opportunity. It just means a greater variance of prices. So whilst most traders are not identifying the imbalance, you have identified it. You're not getting caught up in the price ladder, but you're executing exactly where you want to, and ultimately taking advantage of the auction imbalance. Okay, let's now move on to, hands down, one of my favorite books within the additional reading section. Now, if you haven't heard about this book, just put it on Amazon straight away. Tim Ferriss, Tools of Titans. an amazing book. He's actually just released another one, another book that's come out, very similar. What this whole book goes about, very simply, just very briefly, Tim Ferriss, practical application, author through personal experiences. So he takes his own personal experiences, he adopts the habits and the approaches of other people, he tries them out, and then gives his opinion on them. Okay, he elaborates on them. That's pretty much what the whole book goes about. In terms of summary, you effectively learned from 200 masters across all industries, whether it's health, sports, science, life, it doesn't matter. So 200 people at the top of their game, they share with you their characteristics, their habits, the things they do, you know, some of their thoughts, some of their best guidance. They share all this with you, and that's what this book's about. It's a summarized version of 200 of the best performing, whatever you want to call them, performers in the world. Okay, now, obviously, in terms of action, it's going to create, what's going to force you to adopt some of the practical processes. There's a lot of incredible processes you can take from this book. Things like taking nice cold showers in the morning, things like priming techniques, all sorts of things that you can definitely utilize in your trading. Now, in terms of the highlights, obviously, he does focus on strengths and weaknesses of titans across numerous industries, practical methods to apply that have proven to be successful, common characteristic traits amongst successful people, tactics, routine, habits, and tools of world-class performers, as well as some abstract edges. So, in essence, as you're reading, you're going to want to go on YouTube, you're going to want to go on the internet, watch videos about these top 200 performers, you know, find out who they are, and then you suddenly going to want to start to adopt certain of their processes because they make sense to you. Fantastic book. Make sure you get this on your reading list as it's incredibly valuable. All right, let's go wrap up now with our drill section. So practice does make perfect. We're at the drill session again. As you know by now, watch the drill, complete your template, watch the drill with the guided tuition, make adjustments to your template. When you're comfortable, go back and watch some of the videos within the unit, again make another template. When you're happy that you understand the strategy and you're ready to move on, then do so. Alright, this then concludes now Unit 9, and this is obviously now our 4th strategy we finished. We have got another 6 to come, so hang tight. And obviously, as Aristotle said, we are what we repeatedly do. Excellence, therefore, is not an act, but a habit. Okay, so you are repeatedly what you do. So doing this template every single time and doing it, you know, maybe 3 times a day at the end of every strategy session, and then maybe doing it over a course of a month 90 times and doing it over a course of 12 months, suddenly you're going to form an incredible habit of completing a template. Okay, and ultimately you will become excellent at it. Thanks guys, and I'll see you back in Unit 10. So welcome to this drill session. This is for strategy for the auction imbalances. I hope you've enjoyed that unit. I think it's auction imbalances are a wonderful aspect of the footprint tool, and you know, even if you don't necessarily trade the strategy, you know, the standalone strategy, the actual auction imbalance can really aid you in some of your other strategies. So let's just get straight onto the footprint. What we can see, quite a build up in volume. This is the Euro-dollar 5-minute rotation. Note, I'm not using a imbalance rotation setting here. You can obviously set those. So you're really going to be tested here in terms of, or you would have been really tested in terms of identifying those imbalances. But we can see straight away a bit of a break up comes, and our first imbalance is left on the chart. So that's the first thing we can see, a nice little imbalance from the 60s up to the 65s. You know, a real lack of trade taking place. We've got 14 by 15, 8 by 24, 3 by 47, 41 by 74, 26 by 107. You know, quite a lot of imbalance on the diagonals. Now, the first thing we obviously noted is that this in its own is not our strategy. Our strategy is to wait for the rotation, let it come back and test ultimately that imbalance area before we get long with the trend. Now, do note, obviously, we spoke quite important, you know, is the volume. Volume is a real identifier in terms of continuation of the imbalance and how aggressive that continuation might be, where if we have low volume, there's a much higher probability that the imbalance will reverse itself and fill itself out. So, that being said, we can straight away see that, you know, really, really dark volume on this breakup, 2,370 contracts. So we can see there's a real intent in terms of the volume, and I think that's the first thing we need to observe. High volume, you know, break to the upside with an imbalance does suggest we've got the potential for a little bit of extension. So what we're looking for now, obviously, is that first little bit of absorption on a retest of the ultimate imbalance. Now, the imbalance area starts, we can see obviously we've got a 3 by 51 there, and then we've got a 52 by 114. So depending on your settings, we can see that imbalance starts somewhere around that 118.62.5 area. So let's get back to the next rotation. Let's see what it looks like. So our next rotation comes in, and let's see what happens. Now we're looking for a fill, or we're looking firstly for a little bit of absorption, and then we're going to execute a market. Now note, again, most of the time in almost every single one of the strategies we've dealt with, I always sort of prefer you to not preempt the market. I prefer you to wait for, you know, a signal, wait for the market to give you the clue. Now, the clue in this strategy is to wait for the absorption ahead of the elephant. So we're looking for any kind of absorption around the 62.5 marker for us to ultimately execute this trade strategy. Okay, so we can see market comes down. It trades a 1 lot at that previous dark area. Now again, we might be tempted to get in here. We might be tempted to jump in and jump on that. And again, yes, this is one of the real factors you have to, you know, be disciplined with this trade strategy. You've got to say to yourself, if you're jumping in at this price point, you're foregoing 2 prices. Okay, now again, in the long run, 2 prices, or in the short run, 2 prices might not seem like a lot, but in the long run, those 2 prices add up equally. You know, the lack of discipline shown will come out and catch you at some point. Okay, also don't forget, if you're taking 2 prices less in terms of profit, it means you're taking 2 prices more in terms of risk. So in effect, the net is actually a 4-tick swing, you know, in the event that it does go wrong. So just factor that in when you're obviously considering this trade strategy. Okay, so let's just move the tape on a little bit forward. Let's get to that point. Okay, so bang, market comes down. It trades our price, 62.5's trade, 9 contracts trades, comes back again, and 19 contracts trades. Note what it's doing in front. Okay, note how we're getting quite a little bit of absorption here, quite a lot of selling coming in here. So we're seeing the absorption taking place on the bid, the reloading's taking place. 53.76. So the buyers are happy to be reloading. We've now we've got our fill, or we're trying to be a buyer of 62.5s, which we filled there, or we can lift the 63s. But we've now got our fill, so we've seen the absorption taking place in front of the elephant, and that's given us the conviction and the confidence to enter. Again, note the continuation of the absorption, no real buying taking place, mostly just selling into the 62s and halves and 63s. Okay, so this is the absorption we're looking out for. This is the kind of price response, the signal we're looking for in order to initiate. Now, in terms of the risk, as we said, we always keep our risk is inside of the low volume area, inside of the imbalance. Okay, that's the real key. You don't want to be stopping out one tick below ultimately where you got in, because this whole area, all the way from even down to the 87s by 6s, so from sort of 58s all the way up until 62s, we've got an imbalance. So for me, likely to put a stop probably in and around that 60. Don't really want to see those zeros trade out. So we've got a really tight stop. You can see almost 2 ticks, looking for the retest of the extreme, if not, hopefully an extension as well. So really good open-ended target here with a very, very managed tight stop. Okay, now note obviously some of the metrics on the second rotation. We can see the delta quite flat. We can also see the delta on the session still holding that positive delta. Okay, next rotation comes in. Note now you can see the absorption that took place quite strong. Okay, we can see the real color dynamic there, some nice dark shade colors there, and ultimately what we're looking for now is that little bit of a bid to come into the market, which we eventually get, and we start to see the rotation back up. Okay, so this was the first then of the imbalances that you dealt with, that you saw within this practice example. Now, what was interesting about this imbalance example, and the reason I don't like using the picture perfect examples is because I don't want to give you this this pretense that every one of these is going to be straightforward and you make money like straight away. All right, I never wanted to come across like that. The variances do change. The important part is now, as you're going through your template, what you should have noticed about this entire imbalance, and I'm going to fast forward it to show you, you should have noted that this imbalance had a number of rotations. Okay, so what you want to do is you want to go and highlight, well, normally imbalances, they have maybe 10 minutes or 2 or 3 rotations, and then they either extend on the extreme or they fail. Okay, so you want to go and identify what are the good ones versus what are the bad ones. I can tell you this was a very slow imbalance. Okay, it's very unusual to have seen this many rotations before the market then extended. Okay, I'm going to keep going through it. We can see the market keeps holding on to that lower end of that imbalance, not quite wanting to fill the imbalance, and eventually we can see the market does prep itself ultimately for a move higher. So again, let me just go back one sec. Note count the number of rotations, guys. This is quite crucial. We've got 1, 2, 3, 4, 5, 6, 7, 8 rotations ultimately before the market then preps itself for the move higher. So factor that into the analysis. Okay, if you've done 10 of these examples and you find that the euro tends to extend after a maximum of 4 extensions, and today was 8, well then you create a new rule for yourself, which is that if the market hasn't extended, by the time, potentially after 4 rotations, to reduce the risk, I simply just get out. Okay, so create some sort of a rule-based approach so that you're using the information that you're observing to your advantage. Okay, what we're going to see now is then the second of our imbalances. We do get our extension. We can see the extension there. Note the market now breaks out of that little tight range it's been in, and we then get a number of imbalances left. Okay, so we can see a whole bunch of zeros below, another 0 and a 2, real strong diagonal buy imbalances coming in. Again, another 0 by 37, 8 by 40. So a number of imbalances starting all the way down at 64s, all the way up until the sort of 70 area. So that's the level of our imbalances. Now again, if you're still long, you don't get out. Okay, the market hasn't given you a reason to get out. You trail that stop. Again, now we move it back. If we're not in a trade, we move our stop up into this imbalance, the next imbalance. And if we're looking for a trade, well then we rinse and repeat. So we wait for the next rotation. We allow the market to come back and absorb. I'm just going to get to that next rotation. So we can see we wait for the market to come back, let it test that imbalance around the 70 area. So the market comes in, note the darker shading again, there's the absorption. We're looking for our longs now at 70.5, and we wait for the rotation and extension again. Alright, so it's a lovely example in the sense that it does show you two imbalances. It shows you, what the first imbalance that takes a long time to retest and extend the extreme, whereas the second imbalance almost instantaneously retests that extreme point. Okay, that then is obviously the end of our auction imbalance drill session. So important, go back now onto those templates, make the changes you need to do, add the notes you need to add, and make sure you're learning from these little drill-based sessions. Of course, you obviously have got the examples from the unit that we went over. You can go now and complete those, and again complete a template. Alright guys, that brings us then to the end of Unit 10, and I will now see you guys in the next unit.